Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. Thanks for joining me today. I wanted to talk a little bit about the shareholder meeting that Warren Buffett held for Berkshire Hathaway this past weekend. He said a lot of very important things that everyone should be aware of. The first and most important thing he said is that he remains an optimist about the U.S. economy. And if there's anything you should take away from my talks and the investment strategies I share with you is if you're not a long-term believer in the health and prosperity of the country, then the stock market is the wrong place to be. People who've been bearish on America and the U.S. stock market for years have not had much to show for it, but obviously they're going with their convictions. And my conviction and Warren Buffett's conviction, our shared conviction, is that equities are the best performing asset over time, and that whatever may happen to the U.S. economy, the U.S. stock market in the short term, that the long-term prospects are excellent. You can look back at every recession, every pandemic, every sell-off in the market for whatever reason, and it's always been a buying opportunity. And people looked back months or years later and were happy that they stepped up and took advantage of low prices. So being an optimist is important. But Warren Buffett also said something else that's worth noting, and that is that he's hunting with a rifle rather than a shotgun. Now, what is the shotgun approach? People who buy an S&P 500 index fund or some broadly diversified vehicle are, if you own the S&P 500, you own 500 different companies. Some of those companies are going to do very well, some are going to do very poorly, and a lot of them are going to do sort of average. And so you get the market average return. But that's not what Warren Buffett does. He looks for individual companies that are likely to outperform, and he avoids the ones that he thinks are going to do poorly. So, for instance, he mentioned that he sold all of his airline stocks. Now, there's no great surprise there. The airline industry is in a very tough situation. They're looking for a government bailout. And personally, I'm not interested in buying companies that need a government bailout. I'm not saying they won't do well if they get the bailout and business returns to normal, but you really want to be looking for healthy companies that are likely to report sales and earnings that are better than expected. So I think that's important, is when you're looking to prosper in the stock market, yes, you can certainly do better than cash or bonds by buying an S&P 500 index fund. But if you want outperformance, you need to be very selective about what you buy. And there are companies out there right now that are set to prosper despite the pandemic: healthcare companies, drug companies, food companies, utilities, defense contractors, e-commerce leaders. Companies like that are going to do very well in the weeks and months ahead. And so that's really where I'm focusing our attention in the Oxford portfolios, because those are the businesses, those are the industries that are likely to see exceptional results and exceptional returns in the weeks and months ahead. So anyway, that's it for today. As always, feel free to sign up for Liberty Through Wealth, my free e-letter, where I'm talking about what's happening in the economy and the markets on a daily basis. And you can just click on the link below, and we'd love to have you join us. So thanks so much for joining me, and I'll see you next time.